Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today, we're going to dive into the always fun topic of life insurance.
Oh, come on. I thought we were going to talk about going to the DMV today.
Well, yes, that's an equally fun topic, but we'll have to save it for another day. So a while back, we had an episode where we talked about insurance, episode number 14. But in that episode, we covered all the different types of insurance you should have as a physician. So we discussed life insurance, but more so from a high-level perspective. And today, we want to take a deeper dive, and specifically into how life insurance needs and strategy change over time. And the reason we wanted to do this is because life insurance is one of the most common and one of the most important types of insurance out there. And there are some common mistakes we see being made in this area. So we thought it'd be worthwhile to share our thoughts and hopefully give you a good framework for how to approach it. So Andrew, why don't you kick things off with a general overview?
Sure. So starting with a basic definition, life insurance is a product you purchase where you pay a certain amount of money each year, called insurance premiums. And in exchange for paying those premiums, if you happen to pass away while you have the insurance coverage, the insurance company pays a lump sum of money to your beneficiary, and most commonly a spouse, but it can be anyone. Now, with that definition in mind, it's easy to understand the purpose of life insurance, at least the primary and most common purpose, which is to protect the people who depend on your income if you were to pass away and your income went away. So it essentially provides a financial safety net for your dependents. Everyone has a different need for life insurance based on the specifics of their situation, but there's a general trend in terms of how that need evolves over time. And the trend is that your need is highest when you're younger and then declines over time. And if you think about the typical situation, this makes a lot of sense. Let's say you're a young parent with one or more kids. In this case, you likely have a high need for life insurance because you're earlier in your career and haven't had as much time to save and accumulate assets. Your kids are younger, so you have more years where you'll have to fund their living expenses and potentially save for college. And for you and your spouse, you have many more years between now and retirement where you need to save up. However, if you fast forward for the same person to the point where their last kid is off to college, the situation is much different. Expenses and savings related to kids have fallen off, the value of retirement accounts have grown, and debt, like the mortgage, is lower because it's been steadily paid down over time. At this point in life, the life insurance need for the same person is significantly lower, if it even exists. So if you don't have anyone depending on your income, you don't typically have a financial need for life insurance. However, for anyone who does have people depending on their income, the trend is that life insurance needs are highest when you're younger and earlier in your career. They gradually decline over time as you get older, and you eventually reach a point, either later in your career or in retirement, where you no longer have a financial, quote-unquote, need for life insurance.
It's going to be a great day when you and I no longer have a need for life insurance.
Absolutely. I can think of a lot of things I'd rather be spending money on each year. So that's an overview of the purpose and life cycle of life insurance. But to make things nice and confusing, when we talk about life insurance, there isn't just one type. And unfortunately, there are many different variations. So Trent, why don't you touch on that?
Yeah, the financial industry doesn't like to make things easy for people, does it?
Definitely not.
But to keep it as simple as possible, there are essentially two basic types of life insurance. There's term insurance and there's permanent insurance. With term insurance, you pay for the life insurance coverage for a specific period of time, or term. You pay the premium each year for as long as you need the coverage, and once the term is up, or you stop paying the premium, the coverage ends. Permanent life insurance, on the other hand, is much different. And on the front end, it's worth noting that permanent life insurance goes by many different names, including whole life insurance, cash value life insurance, universal life insurance, etc. But a big difference with this type of insurance is that, as the name implies, it's permanent. In other words, you have it until you die. Another big difference is the cost of premiums. Most permanent life insurance policies are actually a combination of life insurance and an investment product. So you're paying for both the insurance and the investment product, and therefore the premiums are dramatically higher. For example, while for term life insurance, depending on your age and the amount of coverage, you might pay $500 to $1,000 a year in premiums, for a permanent life insurance policy with the same death benefit, the amount paid out if you die, you could pay $2,000 or more in premiums per month, so obviously a massive difference. Permanent life insurance is also much less flexible in that you're required to continue paying those expensive premiums each year, and if you stop paying them, you can run into issues, like walking away with less money than you paid in if you surrender the policy within the first few years after purchasing it, or potentially having the policy lapse down the road and having to pay additional money in taxes. While there are some rare situations where permanent life insurance does make sense, They're few and far between, and for the overwhelming majority of people, term insurance is the right type of life insurance to have and is what we prefer. With permanent insurance, since it combines an insurance product with an investment product, it tends to be inefficient since the insurance coverage is expensive and the investment returns are poor. When it comes to insurance, the purpose is to protect against a risk. So we're advocates of only getting the amount of coverage you need for the time you need it and then paying for that coverage as cheaply as possible. So in the context of financial planning, this means getting term life insurance to protect your risk, then using the money saved by not getting permanent life insurance to either invest or allocate toward other uses or goals in your financial plan. So that's a quick explanation of the two basic types of life insurance. And one other thing to note is that within the context of term life insurance, there are also two ways to purchase it. There's individual coverage, which you purchase on your own, and there's group coverage, which you purchase through your employer and payroll deductions. There are pros and cons of each, and we'll explain these in more detail as we talk about some of the important things to consider with life insurance over time.
Yeah, so what we want to do now is move through the different career stages and talk a little more about some of the things to keep in mind and some of the strategies you can implement when it comes to life insurance. We'll break it down into early career, mid-career, and late career or retirement. Starting with early career, as mentioned earlier, assuming you have people who depend on your income, this is when your life insurance needs will be the highest. Knowing you have a higher need for insurance and a longer time period for needing it, you want to make sure you pay as little as possible for the coverage. There are several things to consider here, but the first is the type of coverage. We're obviously proponents of term life insurance, but even within that category, there are two different types to understand: level term and annually renewable term. With level term, your annual premium is fixed and is the same every single year. For example, you might get a quote for a 20-year policy with a $1 million death benefit and an annual premium of $750. Well, for this policy, you would know that the cost is only going to be $750 a year for each of the next 20 years, or as long as you decide to keep it. With annually renewable term, on the other hand, the premium changes over time. Life insurance pricing is based on age, so the premium will be lower in the earlier years with the policy, but it gradually increases over time as you get older. While this option can result in the cheaper cost of insurance when you're younger, if you end up keeping the policy for the full term, in this example 20 years, you'll typically end up paying more in total premiums for the insurance over those 20 years. So from a cost and certainty standpoint, having a set price each year, we generally prefer level term. Along similar lines, you'll want to decide whether to get group life insurance coverage, which is purchased through your employer through payroll deductions, or individual coverage. And when we talk about group life insurance coverage, we're talking about the optional group coverage, or an amount beyond what's provided by your employer free of charge, which is often a token amount like $50,000 a year or maybe 1 to 2 times your salary. Of the two options, we typically prefer individual coverage for a couple of reasons. One is that individual coverage provides more certainty since it's independent of your employer and stays with you regardless of whether you change jobs. You might have a situation where your current employer offers great group life insurance coverage, but a few years down the road, you move to a new employer that doesn't offer good coverage. When you have an individual policy, you don't have to worry about this. Another reason we prefer individual coverage is because you're able to choose the level term option I just mentioned, whereas most optional group life insurance coverage is annually renewable term. So the cost might be lower in the earlier years, but it then increases as you get older and can become quite expensive over time. Although one thing to note is that for the optional group coverage, a health exam is often waived for amounts below a certain threshold. So if you're someone who has a medical situation such that buying an individual policy would be impossible or extremely expensive, the optional group coverage might be your best or only option. But assuming you are able to get level term, individual coverage, the last question is how to structure it. And this is where it's worth considering a strategy called laddering. Let's say that based on your analysis, you have a calculated need for life insurance of $3 million. Well, rather than just buying a $3 million policy, you could consider breaking it down into parts, where, for example, you might buy a $1 million 30-year policy, a $1 million 20-year policy, and a $1 million 10-year policy. Knowing that life insurance needs gradually decline over time, by using this laddering strategy, rather than paying for $3 million of coverage for the next 30 years, you can better match your coverage with your situation over time and only pay for what you need. In this scenario, your coverage automatically adjusts as you get older, since a policy rolls off every 10 years, and your amount of life insurance falls as your need falls. You'll want to get quotes to compare the costs, but this is a way to potentially save money in life insurance premiums while still adequately protecting your risk along the way, which is exactly what we try to do when it comes to life insurance.
So that's a good rundown of the early career phase, which we typically think of as the period from your 30s into your early 40s. And now we'll move on to the mid-career phase, which we generally define as the period from your early 40s into your early 50s, where many people are in the middle of raising families but aren't quite thinking about retirement in a serious way as of yet. And this is really somewhat of an in-between period when it comes to life insurance. Following the framework we outlined earlier, this is a time when your life insurance needs are starting to decline, as you pay down the mortgage and save up for big goals like retirement and college. But in most cases, there's still a need for coverage. During this phase, what we recommend is revisiting the calculation of your insurance needs to see where you are in terms of coverage relative to your calculated need. You may find that you still have a need that's similar to your coverage, or you may find that your need has fallen to the point where you now have excess coverage. If that's the case, it becomes a function of weighing the cost of your excess coverage with the benefit it provides. Most notably, the peace of mind that your family would be more than taken care of financially if something should unexpectedly happen to you. Different people value that peace of mind aspect differently, but as a general statement, we find that, assuming they have cost-efficient term coverage, people tend to be happy continuing to pay those premiums during these years for the additional financial cushion and peace of mind, even if there's potential to save some money each year. Again, this ultimately depends on the specifics of your situation, but this is the trend. Now, one thing that's certainly worth doing during this period is reviewing the cost of your life insurance, especially if you originally purchased annually renewable term rather than level term, either as an individual policy or through your employer. As mentioned earlier, annually renewable term insurance gets more expensive over time as you get older, and the probability of you dying increases. And the way this works is that there are age brackets, often 5 years, where as soon as you enter the next age bracket, your cost jumps up and then stays at that new level until you reach the next bracket. To illustrate this using the group rates for one of the big health system employers in our area, when you turn 35, the cost of the optional group coverage increases by 23%. When you turn 40, it increases by another 53%. And when you turn 45, it increases by another 71%. And when you turn 50, it increases by another 65%. So for the same amount of life insurance coverage, you'll end up paying more than 5 times as much for it at age 50 compared to what you paid for it in your early 30s. Knowing the way pricing evolves for annually renewable term and most optional group life insurance, if you do have this type of coverage, it's really important to revisit the cost in this mid-career phase to understand what you're paying versus what you get. So that's really the punchline for the mid-career phase. Your life insurance need is declining during this time, so you want to revisit your need relative to your coverage and what you're paying for that coverage to decide whether it makes sense to continue paying for your coverage or drop any of it. And for many people, the path is to do nothing during this time, even if it means an additional cushion.
Now, the last phase we want to touch on is that of the late career or retirement phase. We think of this period as your mid-50s onward, where many people either have an idea of when they want to retire or at least starting to think about it. This is also a period where personal financial burden is easing as kids are graduating from college and the mortgage balance is shrinking or even gone, so expenses and debt are decreasing. At the same time, retirement account balances have grown and people are moving closer to the point of being able to fund their retirement. Altogether, this is clearly a recipe for a declining or disappearing life insurance need. And while we talked about revisiting your need versus coverage in the mid-career phase, this late career or retirement phase is where it becomes really important. If you've reached the point of being able to self-insure against the risk of death, there's really no financial reason to continue paying for life insurance. In other words, if something happened to you and based on the financial assets your household has accumulated with your spouse and potentially surviving dependents, they would be able to continue living and paying for their expenses and meeting any other financial goals from now throughout the duration of retirement. There's no need to continue spending money each year on life insurance premiums. Again, there might be a personal preference or comfort level to continue doing so, but from a numbers standpoint, there's no need. In terms of reviewing existing coverage, if you originally purchased individual term life insurance, it's possible that the term has run its course and the coverage has ceased automatically. For example, if you purchased a 25-year term policy when you were 30 and you're now 56, that policy will have expired, and you'll no longer be paying a premium. In cases like this, it might be tempting to look back and think about all the money you quote-unquote wasted paying those insurance premiums for 25 years when you're left with nothing to show for the money. However, with insurance, especially life insurance, you don't want to have to actually use it. So you should be happy that you had paid those premiums without getting any money in return, since it means you didn't die prematurely, and at the same time, were able to protect your family against that risk along the way. If you have an individual term policy that's still in place, now is a good time to confirm how much you're paying in premiums, especially if it's an annually renewable term policy where the cost is likely dramatically higher now than when you bought it. And if you have optional group life insurance coverage, it's also critical to check and see how much you're paying each year for the coverage you have. Going back to what Trent outlined above about how the cost of group life insurance changes as you hit higher age brackets, the cost can be extremely high at this point. This is a common issue we come across with employed physicians who are in that pre-retirement phase. Oftentimes, they signed up for that optional group life insurance early in their careers when the annual cost of it was low, and then left things on autopilot with that election in place and didn't check their pay stub over time to see how the cost has increased. Depending on the age, the numbers can become pretty dramatic. We've had clients who are inadvertently paying $5,000 up to $10,000 or more just for the life insurance coverage they didn't even need. So by dropping that coverage, we were able to save them a ton of money while knowing they had the financial assets to self-insure. So this is our biggest recommendation for anyone in the late career phase that is optional group coverage. Make sure you check to see how much you're paying for it. In bigger picture, just to reiterate, this is a time where life insurance needs have fallen dramatically or even disappeared. So if you do still have coverage, make sure you understand how much you have relative to your need, and based on that, decide whether or not it makes sense to continue paying for any coverage you have. This can be an easy way to save a significant amount of money in unnecessary insurance premiums while knowing you aren't putting yourself at risk financially. All right, that's enough life insurance talk for one day. Do we still have time to talk about the DMV?
Well, unfortunately not, but maybe next episode. Well, we hope this is helpful to everyone as you think about life insurance as it pertains to your own situation. It's obviously a dynamic area that changes a lot over time, and by being strategic with how you approach it at each phase, you can end up saving a lot of money while still protecting your risk. To give a recap of some of the key points, number 1, life insurance is a product you purchase to protect those who depend on your income if something were to happen to you and you passed away prematurely. Number 2, because of this, life insurance needs tend to be highest when you're early in your career and have a young family, and they gradually decline over time as you get older. Number 3, in the early career phase, it's important to have the right type of coverage. For the vast majority of people, this is level term life insurance rather than permanent life insurance or annually renewable term. One strategy to consider when buying your life insurance is laddering, where you purchase multiple policies with different time periods so your coverage gradually rolls off over time and you save premiums along the way. Number 4, in the mid-career phase, life insurance needs are starting to decline but still exist, so it's worth revisiting your need relative to your current coverage and how much you're paying for that coverage. Based on this, you can decide whether to drop some of your coverage to save money or keep things as is for the peace of mind. And lastly, number 5, in the late career or retirement phase, most people eventually reach a point where they no longer have a financial need for life insurance and can self-insure against the risk of death. In this phase, it's extremely important to review your need relative to your coverage, especially if you have optional group coverage or annually renewable term coverage, since the cost is linked to age, and as you move into your 50s or 60s, that cost can become extremely expensive, especially if you no longer have a need. Well, thank you to everyone for joining us for another episode of the show. If you want to check out the show notes, you can find them at the podcast page of our website, mdwmllc.com/podcast. Also, if you have thoughts to share or questions you'd like to have answered on the show, please email us at info@mdwmllc.com. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.